Hello students, and welcome to Module 2. You've successfully passed Module 1 and you learned a little bit about why investors should consider trading options. You learned a little bit about my background, and you also learned a little bit more about Don Fishback. In this module, we're going to get down to business. We're going to start learning what options are, along with some of the terminology used in the industry. To trade options successfully, you have to know what it is you're trading and how it works. You also have to know how to tell your broker what you want him to do. So let's get started. What is an option? Is it an opportunity? Is it a choice? Is it a right? Is it a selection? Yes, it's all those things. Dictionary.reference.com defines an option as the power or right of choosing. When we're trading options, we're really dealing in choices. Sometimes we buy the right to make a choice, and sometimes we sell them. The first option that most people get involved with is a call option. A call option gives the holder the right to buy a certain number of shares of an asset at the strike price within a set period of time. I think the reason most people try call options first is because they're most like a buy and hold strategy that most people are familiar with. It's okay if it doesn't sink in right now. We're going to go through some examples in a minute that should clear things up for you. A holder of the option is the option buyer. A holder pays money to a grantor to enter the option trade, and they receive a right in exchange for their money. The phrase buy to open is important to remember. It doesn't mean the same thing as buying a stock. We're not necessarily bullish on the stock when we use the term buy to open for an option. In the case of a call option, buy to open would be bullish, but the term buy to open means we are buying the rights of a holder in the trade. A grantor is an option seller. A grantor receives money from a holder to enter an option trade. They begin the trade by placing a sell to open order with a broker, and they take on an obligation to the holder for their money. Again, a sell to open order is not the same as selling a stock. We're not closing a bullish position or taking a bearish position. We're simply selling an obligation to the holder to enter the trade. If the option holder decides to exercise their right, the grantor is legally obligated to honor the transaction that the holder bought the rights to initiate. So what is a strike price? The strike price is a set price at which the underlying asset will be traded if the right purchased by the holder is exercised. I should point out that the holder doesn't have to exercise the right that they purchase. They paid for the right to decide. They have the choice. There are multiple ways of closing option trades. For now, let's talk about closing the trade by doing the opposite of what we did to enter the trade. That means if we bought an option to open, we would sell to close. We would sell the right that we bought to exit the trade. If we sold to open the trade, we would just do the opposite to exit. We would buy the right back that we sold and remove our obligation. Again, there are other ways to exit, and we'll talk about those later. Now let's talk about puts. Put options give the holder the right to sell a certain number of shares of the asset at the strike price within a certain period of time. An easy way to remember is that the holder can literally put shares in the account of the grantor. A call option holder calls the shares away. The term or duration of an option trade is the length of time for which the option holder has the right to exercise the option. There are some option styles that have limits on when you can exercise the option, but we'll talk about those in a minute. The term usually is thought of in terms of the date at which the options expire, and the holder must exercise or lose the right to exercise after that date. An option is often referred to as a contract. it actually is a legal contract between two parties. The reason we can trade them without hiring lawyers to negotiate the details each time is because they're standardized. When you set up your brokerage account, you did sign legally binding paperwork that locks you into the terms of these contracts. You also had to receive a copy of a document called Characteristics and Risks of Standardized Options. And just like any other contract, you signed something saying that you understood the risks involved, whether you read it or not. I've helped people who started trading options without really understanding the risks. They usually end up coming for help a little bit later when something bad happened, and they ask me to explain what happened. If they had studied that document, they would have known the terms of their contract better before they entered the trade. One of the best features of option trading is the ability to combine options to create trading opportunities that meet your specific requirements for direction, risk, reward, and probability. Option combinations provide us with much more power and flexibility than traditional investing methods. When combining options, you can buy calls and puts. You can buy to open and sell to open at the same time. You can enter varied numbers of contracts. You can include long and short positions in the stock. As long as you know what you're doing, you can create totally custom strategies for any investing situation. Underlying assets are the valuable objects on which the options are based. You can trade options on real estate, stocks, exchange-traded funds, mostly they're called ETFs, stock indices, futures, and more. If you buy options on Google, then Google shares are the underlying asset. If you buy options on gold, then gold futures are the underlying asset. If you buy options on real estate, then the property is the underlying asset. Let's talk a little bit more about real estate. Real estate's a good asset that everyone can understand. Let's say you know of a property that is currently worth $100,000. You think the land is going to quickly increase in value, so you buy an option on the property. You negotiate with the property owner, and you both agree to the terms of the option. You agree to pay $10,000 to the owner now, and they agree to sell you the property for $120,000 if you decide you want to, anytime within the next 12 months. Now, using our terminology, our contract has an underlying asset in the property. Our strike price, the price that the owner agreed to sell the land to us for, is $120,000. The term of the contract is 12 months. We have 12 months to decide if we want to buy the property for $120,000. We paid the owner $10,000 to enter this contract with us. Now let's look at a few scenarios to see what happens to our trade under different situations. Let's say a month after we enter the trade, we discover a natural toxic sludge on the property. The property instantly becomes worthless. Would we choose to exercise our right to buy at $120,000? Of course not. We would be actually pretty happy that we didn't buy the land outright to begin with, and that we only lost our transaction cost of $10,000. Now let's look at another scenario. Let's say the property value doesn't move at all. After 12 months, it's still worth only $100,000. Are we going to exercise our right to buy at $120,000? No. We would admit that we were wrong about our expectation and take our $10,000 loss. Now let's say the property does increase in value and we find someone that will buy it for $125,000. Would we exercise our right to buy at $120,000? Assuming the buyer pays all the transaction costs, we could reduce our loss on the trade by $5,000. So we would exercise our right. In fact, at any price above $120,000, our strike price, we would start reducing our loss in the trade, so we would want to exercise our right. If we were lucky enough to find a buyer at $130,000, we can exercise at $120,000, and the difference would completely offset our cost for the option. We don't make any money, but we're happy that we didn't lose any money either. Now let's say instead of finding toxic sludge on the property, the current owner finds oil. An oil company finds out and they go to the owner and make an offer of $500,000. The owner has to tell him, "I'm sorry, but I can't sell it to you. I sold an option to this other guy on the property and he has the right to buy it first." So the oil company then comes to us and says, we want to make you this same offer. So right now we're extremely happy. The current owner is really ticked off that he sold that option. But we absolutely, under this circumstance, we exercise our right to buy at $120,000 and we sell the property at $500,000. That leaves us with a net in there of $380,000. After you subtract our initial investment, we're left with a total profit of $370,000. Now there's another way to do this transaction that would probably be a little bit easier. Instead of exercising our right, we could just simply sell the option to the oil company for $380,000. Then they could go and exercise the right if they wanted to. This method of exit would probably save us a little bit of money on the transaction costs. Now realistically, property values don't usually change that drastically. They can, but most often the price would drift slightly and the option buyer would not make money. The options would be priced to account for the slight drift. However, if the option holder in these scenarios did exercise their option, they would get property at the strike price. And that brings us to another term. While it might be fashionable to trade Apple and Google stock these days, I'll bet you didn't know that options have style. In fact, they have multiple styles. The first style I want to talk to you about is settlement style. Settlement occurs when the holder exercises their right. There are two styles of settlement that we need to talk about. The first is physical delivery. In this settlement, the holder receives the underlying asset. In the case of stocks and exchange-traded funds, you would receive shares of the asset, or in the case of a put option, you would receive a short position in the asset. In real estate, you would get the property. To completely exit a physical delivery settlement, you would have to then close your position in the asset to exit. In real estate, that means you have to sell the property to somebody else. In stocks and ETFs, that means exiting your stock or ETF position. Stocks and ETFs are all physical delivery. The second style of settlement is cash settlement. This is a lot easier. When your option settles in cash, the holder simply gets cash and they're out. Stock index options are cash settled. Options have another kind of style we need to be familiar with. Exercise style. Stocks and ETFs are American style options. American style options can be exercised at any time during the term. I'd like to point out that exercising early in the term is usually not the best idea. We'll talk more about why later, but if you want to, you paid for the right and you get to decide. Index options most often, but not always, use a European style. European style options can only be exercised at expiration. Large fund managers like this style of option because they can enter the position and forget about it till expiration. They don't have to worry about early exercise in a cash-settled option. Some index options are American-style cash-settled. Beware of cash-settled American-style options. They pose a significant risk because option sellers can have a limited risk option combination and lose more money than the limited risk due to the timing risk. This timing risk comes from the fact that an investor does not learn about the cash assignment until after the market is closed. When the option is exercised, the seller must deliver cash. And even if he has an offsetting position that limits his risk, he can't use that to offset the position. He has to meet his obligation now, and he can't use his offsetting position to help. If the market's closed, he would have to wait until the market opens again to liquidate his offsetting position. And by then, the market price may have changed drastically, leaving the potential for unlimited risk during that early settlement. Basically, selling cash-settled American-style options is not appropriate for all investors. You shouldn't do it unless you can handle the timing risk. Regardless of the style, you can buy and sell an option at any time during the term. Remember in our real estate example when I said that instead of exercising our right to exit the trade, we could simply sell the option? It works the same way with both American and European style options. You can buy and sell the option itself anytime during the life of the option. So don't think that because you have a European style option, you have to wait all the way to expiration to exit your trade. You don't. While we're on the topic of warnings, I want to give you another tip that will save you from getting into a potential nightmare. Only trade options that are listed on bona fide exchanges. The list of legitimate exchanges changes periodically due to acquisitions, but here's a current list. Trading off exchange options is extremely dangerous. You currency traders especially need to be on the lookout. Legitimate exchange listed options offer counterparty integrity. That means exchanges have rules in place to make sure that every party involved in the trade has the funds available to meet the obligations of the transaction. It starts with your broker holding margin in your account. We'll talk about margin a little later, but for now, this is the amount you're required to have in your account to make sure that you can pay for any risk you have in the trade. Your broker does this because the exchange holds them liable if for some reason you don't have the money to meet your obligations. The exchange makes the broker liable because if you can't pay, your broker and your broker can't pay, the exchange has to pay. So when you don't use the bona fide exchanges, you have no guarantee that the person who took the opposite side of your trade has the money to pay you if you make money on the trade. So now I think this is a good place to take a break. I don't want to try and go too fast. We have plenty of time to get through this, and I don't want to wear you out. If you feel like you're ready to take the quiz and move on to the next module, go for it. If you need some time, take a review, ask questions in the live class, or send me an email. That would be great too. I'd be happy to talk to you and answer your questions. I'll see you soon. Talk to you later.